Hi, in this session we are going to look at accounting for receivables. So before actually we look at some particular transactions involving receivables, a quick refresher to understand what receivables are. So basically, as we know that many businesses, they are meant for profit purposes, and how do they generate profit? By selling or offering their goods and services to the clients. Now, when they sell the goods to the clients, of course, they generate revenue. Now, as far as the revenue is concerned, revenue, which you can call it sales revenue for a trading business. Okay, the trading business, they sell their goods. So as far as the sales revenue is concerned, sales revenue can be divided into two categories when we look for the accounting for receivables. Sales revenue is generated on cash basis. So cash-based revenue, cash-based sales, meaning that we go to the shop, retail outlet or supermarket, we get our goods and we pay the money instantly to the retailer. So straight away the goods are sold and the cash is paid and settled. There is no issue at all. Second type of revenue can be generated on credit basis. So credit sales. Now in this transaction, what happens that the business sells goods to the customers on credit basis. So the goods are sold, but the understanding is that the money will be paid to the business later on. Okay, so the goods have been sold, but the payment will be made by the customer to the business firm some other time later on, maybe in 1 week time, 2 weeks time, 1 month time, 6 months, whenever, based upon their understanding and agreements. So here we are actually looking at credit sales. When the goods are sold by a firm to the customer, but customer does not pay instantly, okay, and instead promises to pay at a future date. Okay, commits to pay. Promises means he makes a commitment to pay at a future date. That's called as the credit sales. Now you remember how we used to record cash-based sales. Cash-based sales were recorded, if you remember that. Just to remind you, cash sales are recorded in accounts as we debit cash or bank and we credit the sales account. Okay, but when the goods are sold on credit basis, we don't receive the cash immediately. So we cannot debit the cash or bank. So what happens that credit sales are recorded as debit to something and credit to the sales account. Okay, so the credit is still made to the sales account, but we cannot debit the cash account because we haven't received the cash straight away. So instead, what we do is we use the account which is called as accounts receivables, or in some books, these are called as trade receivables. So these are two names of the same thing. Okay, please don't get confused about it. So what are accounts receivable? Okay, theoretically, please understand this. Accounts receivables, accounts or trade receivables represent credit customers. customers who have to pay to the business firm for the goods sold by the business to the customer. So accounts of trade receivables represent credit customers who have to pay to the business firm for the goods sold by the business to the customer. Okay. So that's where the accounting for receivables starts, when the goods are sold to the customer on credit basis. Okay. So you can say in the series of transactions, that's the first one. Accounts receivables debit and sales account credit. Afterwards, now what happens? What do you think? What will happen? What do you think? Yes, James, what do you think? Right. Okay, brilliant, brilliant. So James is of the view that eventually the customer will come to us and will pay the money what he owes to the business. Okay. So for example, we sold goods for $1,000. So eventually what will happen? The customer will come back to us maybe in a week time, 1 month time, 2 months time, and the customer will pay $1,000. As simple as that. Okay. And when the customer comes, at the time of payment, the customer simply makes the payment. Simply makes the payment. And how the payment is made, of course, you know that we debit cash or bank account. Whenever we receive money, we debit cash or bank. And we credit where the money is coming from. Now, what do you think where the money is coming from? Very true. Well, the money is coming from the credit customer. And remember, credit customer was named as account receivable. Account receivable or trade receivables. Okay. So we can simply debit cash and credit account receivable, whatever the money is given. Right. Sometimes the customers are offered discounts as well, but we will talk about the discounts at a different time. Okay. Now this is basically, that's how the accounting for receivables starts. Now just imagine that the business has given, let's suppose, 1 month or 2 months to the customers that, okay, you can buy the goods today and you can pay us in 30 days. Okay, because of course there is some time period defined between the business and the client. So you will never give the money to somebody. You may give, but generally in the businesses, it doesn't happen like this. You will not give the money to somebody and say, okay, you can pay whenever you like. Businesses don't work like that, do they? No, of course not. They don't work like that. So when we actually lend money to somebody or when we sell goods on credit basis, we always seek some commitment from the client that, sir, when will you like to pay us? Oh, let's sign in on 30 days contract that I will pay you within 30 days. Now, what if the customer doesn't pay within 30 days? Okay. Like for example, rather than the above transaction, what if the customer does not pay on the due date? Then what will happen, my dear friends? Well, yes, you are right, and I agree with you. Business will get worried about it. Business will get worried about it. That, oh, we asked you to pay within 30 days and now you are actually making excuses. So kindly pay us on time. So now that's another thing. So you can say, so it may create a risk against that credit customer. that what if the customer doesn't pay on time? It means the customer may not have the money. The customer may have financial problems. Okay. Or let's suppose, let's think about why would the customer not pay on time? So what do you think? Okay, the customer genuinely forgot. Fair enough. The customer didn't remember genuinely. Okay. But we are human beings. Sometimes it happens. Okay. So the customer genuinely forgot and did not pay on time. What could be another reason? The customer did not have the money, even though the customer had good intentions, positive intentions, but the customer did not have the money to pay. Financial problems. Okay. But the customer knows that in few days I will get the money and I will pay it back to the business. Okay, the retailer. Or instead of paying, the customer decided to die. Death of a customer. And that's why the customer never showed up, because the customer was living now in a different world. Okay. Or any dispute with the retailer. I mean, we bought the goods and we promised to pay in 30 days. But when we started using the goods were not of the quality standards. So we asked the retailer, can you please take the goods back and issue us the refund? And the retailer says, no, I'm not going to take the goods back. And we said, okay, fine, don't take the goods back. We will not pay you the money. So it's a dispute with the retailer, maybe eventually decided by the court some other time. Okay. Or it could be another reason, which is the financial insolvency or bankruptcy. So the customer gone insolvent or bankrupt, and that's why the customer cannot simply pay us. So these could be one of the few reasons. Okay. Customer disappeared or forgot or died or dispute or bankruptcy, some other reasons. And now the business did not receive money back from the customer. So again, risk. What should we do? Okay. Now this risk is classified into two categories for the accounting point of view. For the accounting point of view. Okay. Right. Firstly, there is confirmed risk. Confirmed risk means that the customer is not likely to pay, or the customer will not pay anymore. We can do whatever we can, but we cannot get the money from a dead body. We can do whatever we can, but we cannot get the money back from a financial bankrupt person. He doesn't have the money. How will he give us? He doesn't have any other property. He doesn't have anything. Okay, he's on the road actually. He's now begging. So how can we get the money from the beggars? Okay, we may end up paying him some more, right? So confirmed risk, the customer is not likely to pay anymore. And secondly, which is not a confirmed risk, which is uncertainty, uncertain risk, meaning customer may pay or customer may not pay, but we don't know at this stage. Okay, customer says he will pay, the customer still believes that he will eventually pay, but not sure when or how long will it take. But the customer says, I will pay. It may take a month or 2 or 4 months and so on, but I will pay, right? So this is how there could be. One is that, okay, 100% guarantee customer will not pay. And secondly, maybe 50% chance customer will pay and 50% chance customer may not pay, right? So we will take it from there in the next session. So this was part 1 of the accounting for receivables. Thank you for listening.